Welcome to Section 2, Economic Growth, Measurement, and Forecasts. The GDP, and this is a refresher again for you, there's total GDP. It's also, the change is often expressed as a comparison to prior year or quarter. It's oftentimes annualized. Trends are more important than anything else. It's complicated, includes other statistics and estimates. Not always timely, preliminary and final. We have the preliminary for the first quarter that just came out, and the final won't be out for a while. But again, there's a lot of measurements there. It's not a real accurate number. It's directional. And the GDP is often an indicator of the health of a country's economy. If it's healthy, it's growing, you have low unemployment, wages increase as business demand labor to meet growing economy, and it builds confidence. You feel good. If it's growing too fast, the inflation can be a risk. If you have negative growth, which we've had last year for 2 quarters, less jobs, less production, and it creates negative feelings. And that was complicated by COVID, so you had COVID, it's less jobs, less production. It was a negative feeling as we were in that prior period, the end of 20. 2 quarters of negative growth is a recession. We were in a recession because there was negative growth for 2 quarters. Now, I'm showing you what this is. This is the total gross domestic products, an annual rate, and it's expressed in trillions. So as you can see, here we were in the first quarter, 21.5, and we dropped, came up a little bit, up and up more. Now, when we look at this is the total. What I want to point out is consumer consumption is 15 trillion, 68%. Then we look at gross domestic investment. These are companies making investments to produce products. That's 18% of GDP. We see that we've seen an increase since 2019 of, it's not net exports, it's net imports, because we're starting to spend money, -4. We look at government consumption and expenditures, we see that's 18%. That's a lot of money spent by the government. So I want you this is to give you order of magnitude, okay, of the key categories. If we look at, there was a burst of growth right here, okay, and it's continued to grow, okay, as we're recovering. This being the broadest measure, it grew at a 6.4% rate, okay, right here. This is the first quarter of 21. Here's where it went down 2 quarters, okay, and it's going up, and these are the forecasts coming out of the Commerce Department. But you can see we dropped a lot, we've now grown. So that 6.4% growth on an annualized basis is huge, basically because we had the stimulus payments, and that did a lot, so people were buying. When we look at the growth, we can clearly see that it's driven entirely by consumer products, right there, consumption. In the first quarter, what we saw is a 6.4% change over the preceding quarter, and what we're seeing is personal consumption was up 10.7. So really the growth that contributed to it was all in domestic spending, as people had the stimulus, tax refunds, had been not spending in 20. Again, what we've seen here, this is out of Oxford Economics, that consumer spending is growing at the fastest, strongest pace since 1946. So we're way up there, since this is when the records were kept. But you see it dropped quite a bit, and now it's up here where it is for 21. So this is the consumer spending. Now, and this is come from Bloomberg and Goldman Sachs, and this is their estimate of what we have. This is what's called consensus. This is what all the analysts are coming up with. What we're seeing here is this is Goldman Sachs right here. So for the first quarter, consensus was 5.4, Goldman was 7.5. Consensus for the second quarter is 8.1, 10% is Goldman, and then we see it trailing down as we come back to a more normal return in 22. These are estimates, so directionally things are going to be looking really good, and this is caused a lot by the stimulus. And now we have the infrastructure bill at $3 trillion, and we're going to have a lot of spending, and that's what's growing it. But that is just a shot. That doesn't change the underlying growth. That just pumps money in. This is a trend. If we look at the dotted line, is if we take 2009 and we project a trend line off the 2019 growth, we would be up here. And then we look at the actual growth we're not to the pre-pandemic level yet, and we're still going to be running underneath where we had been on a trend. Now, what is some of the things that, and again, this is out of McKinsey, it gives us a sense, what are the things that are risks to growth, both in emerging and developed countries. Emerging is black, developed is blue. So what you have here is COVID still is a big risk. High levels of national debt. That's here right in the United States. Supply chain disruption. Asset bubbles. Based on what we've seen with growth in housing, we're seeing the equity markets have bubbled up. They're now pulling back. This changes when we look at unemployment, inflation, weak demand, and insufficient. So these are the risks that we have going into the rest of the year. So there's risk associated with that. Just to keep things within context, 24% of the GDP is produced in the United States. Remember, we have a small percentage of a disproportionate share of the wealth compared to the population. But China's pretty big at 1484. And what we're seeing, and when we're looking at this, the forecast for East Asia and Pacific, South Asia, Eastern Europe, much stronger than we're seeing in the advanced economies. And we get to Latin America, Middle East, North Africa, and Sub-Saharan, it's not growing as much. This is per capita. So we're in the middle. Going back to the size, this is China, the growth rate, in India, and the United States. Now, as this progresses, what you see is the United States slowing down and going up. We see China rising rapidly, okay? And we see India coming up. And again, it's a function of the number of people, where they are. So we're the biggest, but that is changing quickly. Caution on using GDP. Right now, it reflects what the economy has done in the past. It doesn't always capture the positive impact of technology, improvements of lifestyles. There's many different measures, economic measures, environmental measures, and social indicators that may indicate a better how a country is doing. Forecasting and nowcasting. More information and the ability to measure economic growth in real time and crowdsourcing information is changing our understanding and use of information. So we oftentimes have so much information to change these assumptions, and companies can do that. We got to have a general sense of where we're heading, and that's the first part on the GDP. The next thing I'd like to take a look at is the employment situation. Because the growth of the economy is dependent upon people working, people earning funds. Originally, we started out that there were almost 26.8 million, that's almost 10% of the American population, hit by the COVID downturn. And when you look at this, you got about 10 million officially unemployed, 7.5 million employed but experiencing cut in pay and hours, 3.7 million people unemployed but misclassified as employed or not in the labor force, and almost 5 million people dropped out of the labor force. So this was a big thing. And let's take a look at what has transpired since these 30 million people were impacted. And they could have, this has an impact on spending, where we're going. It's going to change behaviors. First is the unemployment rate. As you could see that in the first and second quarter, we ended up with almost a 15% unemployment rate, which is huge. And when we look at where we were at the end of April, and they come out on the first Friday of the month, that the people thought it would be about 5.8. The actual rate is 6.1. Now, if you're looking at this on a trend basis, we recovered quite quickly as we are, but we're still well away from where we were just before the pandemic. In fact, we go back that we've been at a 6% rate was in 2014. So this is the unemployment rate. We got to look at that within the context of the labor force participation rate. These are people who are looking, that are in the workforce. It excludes students, retirees, children, and we had this precipitous drop where we had been going along right in this range of between 62 and 63, up and down. And then as we got into 1920, the rate increased, and then it precipitously dropped as people left the workforce. Now, they might have left the workforce because they had to stay home and take care of children, remote schooling, and we're a little bit better. But when you really look at it, 2% of the American population left the workforce. Okay? And that's when we look at inflation, the reasons they did leave. So, got to look at the unemployment rate, this number here, within the context of this, who's participating. When we look at the underemployment rate, and those are people that are working part-time because they have to, but they're working, and underemployed. And when we see that number, we're just at about 10.5%, 10.4. Well, I should really look at that top. But 10.4% of the U.S. is underemployed or unemployed. And that's a lot of people, okay? And that's what's going to impact our economy. But it's also telling us a lot about how business runs. We're also seeing the number of people not in the labor force that are 65 and over, not on disability, just healthy adults who have retired. And that number is well up, and if you see the growth, where it was when we started the pandemic, we were right here at about 28.5, and we're now up to 31 million. So we've added 3 million more retirees. Okay? And that's a drain on the workforce. U.S. unemployment recovery paths, if we look at where we were, if you take the pre-recession of 100, okay, and you look at the trend that had been happening, that pattern, and then we look at where we are, we're not going to get back to the pre-recession levels probably into 23. And this is what happened in the Great Recession. It was flat for many, many years. So that's a current look at the unemployment situation. Okay. This is hitting what we'll call diverse employees hard. And all employees are struggling, as you can see here. 62% of respondents are concerned with their own mental health, behavioral health, which we talked about previously. Hopefully you watched that video. 60% lack of belonging. Female employees are 1.5 times more likely to be concerned about challenges Same thing here, people of color, parents, and we're trying to do that, but there's a lot of gaps. So it's really hit our diverse employees hard, which isn't that unexpected, because I'd like to introduce to you this concept of low-wage workforce. These are the people who have been adversely impacted. And when I first saw these numbers, I was shocked. Okay? So what they did is they broke all workers down between 18 and 64. They called 43% are low wage when they sorted them, 56% high. And when you look at the employed versus unemployed, low wage workers tend to be a little bit more unemployed. Worked only part of the year. Look at this right there. Average median hourly earnings, 10.22 per hour. That's $17,000 a year. 18,000. So think about that. 44% of American workers make a median of 17,953. That's pretty low. High, when you look at the gap here between high and mid-range, our hourly earnings are 26,1022. So this is really quite a phenomena that we're seeing, but we have this divergence in the workforce, and of course wealth goes along with that. Low-wage workers tend to be more people of color. Now let's take a look at how growth has happened since 1970. When we take the bottom 50%, in 1970 they made 19,640. Remember, it was only 44% in the other one for 17. That's now up 27,000, 41%. Okay, but then we go to the 50 to 90, was 44, went up to 75. Their increase was 72. The top 10 to 1% was up 105. Top 1% was up 250. The top 0.1 up 412. So what we've had is a disproportionate share of income and being at the higher levels. They've gained more than those in the lower. But we're still looking at a very low wage, relatively speaking. Now, some of this comes back to education, and educational attainment. And as you can see, everybody suffered here. But bachelor's degree, which you're working on now, the unemployment is only 4.2%. It did not go up as much. And it has been, even in the Great Recession, it did not go over 5%. So you're in a lucky group. Now, that might say, well, you know, it's a function of education. Well, let's just take a look for a second. College education, which you're doing today, 4-year degree or higher. When I graduated from college in 1977, yeah, that's a few years ago, 34% of the American people had a 4-year degree or higher. Think about that. What do you think it is today? Nope, it's 38%. Not much of an increase. By states, it varies from 28 to 50%. In New York State, where we live, much more educated, and closer to 50%. When we look at other countries, though, today, Canada, 56%, Japan, 51%, Israel, 50%, Korea, 47%. So what's happened is that in the U.S., we've stayed relatively stagnant with those that are educated over the past 40-some years. So I think that's important, but that's leading us to, that's going back, if we just step back for a second, that these are our low-wage workers. A significant proportion. There's a relationship here. Now that I'm putting into context for both finance and for organization behavior. So that wraps up our economic current situation and forecast. Next thing we're going to take a look at is going to be policy.